Hello everyone, welcome back to another lesson. If you're new to this channel, my name is Farhan and I help accounting students like you ace their exams. Today we have got a practice question from the topic trade receivables. In this question, you will prepare all the journal entries required to account for the allowance for impairment of trade receivables, and then we will discuss an accounting theory which requires us to make such allowances. You can see the question on the left hand side of your screen, and on the right hand side we've got all the workings which I'll go through and explain to you step by step. What I need you to do now is focus and follow through for an excellent understanding. With that being said, let's begin. Ocean Fresh Trading is a sole proprietorship business that supplies seafood to restaurants. At the end of each accounting year, on 30 September, the business reviews its trade receivables to identify trade receivables which are unlikely to be collectible. So here you can see we are given some information for customers. So at 30 September 2015, we are given two customers, Yum Yum and Delicious Delights, who owed us $6,500 and $8,700 respectively. And then at 30 September 2016, we are given two more customers, which are Fabulous Foods and Fish and Fish. And lastly, at 30 September 2017, we have All Shell, who owed us $8,000. Okay? Now, we expect to not collect these amounts owed by these customers. All right? Now, on 1 March 2016, Yum Yum, whom we expected previously not to pay us, served notice for bankruptcy, and it could only pay now 20 cents for every dollar owed, and the business therefore received a check for the amount and the remainder was written off. All right, so let's look into the first requirement in part A, which requires us to prepare all the journal entries to account for the allowance for impairment of trade receivables for the year ended 30 September 2016 and 30 September 2017. All right, so the first year would be from 1 October 2015, since we understand that the business has a financial year that ends on 30 September. Okay, so that means a new financial year must always begin on 1 October. Since we are preparing the journal entries for the year ended 30 September 2016, the year we will initially focus on are the 12 months starting 1 October 2015 and ending 30 September 2016. So in between these 12 months, we first look into all the transactions that have happened, starting with on 1 March 2016, when Yum Yum confirmed that they are going through a bankruptcy, and therefore whatever amount they owed us, which is $6,500, they can now only pay 20 cents on the dollar, which is synonymous to saying that they will only cover 20% of what they owe. Therefore, on 1 March 2016, from Yum Yum, we will receive 20% of the original $6,500 that they owed us. So therefore, we will receive $1,300 from Yum Yum. Okay? Now, this journal entry will be performed on the 1st of March 2016. So when we're receiving the money from Yum Yum, our cash at bank, which is itself an asset, will increase. Therefore, we will have to debit it, because when assets increase, we must debit it. So we debit cash at bank by $1,300, and simultaneously, Yum Yum was originally a credit customer, a trade receivable, which is an asset. But now that they have paid us what they could, therefore the asset that we had would now decrease, and when assets decrease, we would have to credit it. So we would credit trade receivables, specifically the account for Yum Yum, by $1,300. Okay? Again, we have another pair of entry that we need to perform. So we understand that after Yum Yum has paid $1,300, they now have $5,200, which we have to write off. Okay? And we obviously expected this to be uncollectible anyway. Now, how do we write it off? So when we want to write off a bad debt, it's very easy. So we first reduce the amount owed by Yum Yum. So again, we understand Yum Yum originally is an asset, a current asset, but now that Yum Yum has confirmed that they can't pay the $5,200, they will no longer owe us that money. So when assets decrease, we will credit it. So we will credit trade receivables, specifically the account for Yum Yum, by $5,200. And simultaneously, we have a contra asset account, which is the allowance for impairment on trade receivables account, that we will debit by $5,200. So why are we debiting this account? Now, let's have a discussion on allowance for impairment on trade receivables, which, as we understand, is a contra asset account. But what is the meaning of a contra asset account. A contra asset account is an account that records all the reduction for a relevant asset account, and the relevant asset account in this case is the trade receivables account, who are the credit customers of the business. So whatever sales we have made on credit to these credit customers, there is a percentage which are based on historical sales and assumptions that we expect not to collect. And that percentage is what we set aside in an account known as the allowance for impairment of trade receivables, which records the possible reduction in the current asset account trade receivables itself. So if trade receivables account in itself is an asset account which we debited by default, that means when we create an allowance for impairment of trade receivables account, being a contra asset account, we have to credit it by default. So obviously we would have an allowance for impairment of trade receivables account already created to record a likely amount of uncollectible bad debts. What do we mean by that? So let's look into the previous financial year at the end of 30 September 2015. So at 30 September 2015, we are given Yum Yum owed us $6,500 and Delicious Delights owed us $8,700, right? So at that point in time, the journal entry that we would be performing for these two customers would be to add up the total of $6,500 and $8,700, which was give us $15,200, and then we will transfer that $15,200 unlikely collectible amount to the allowance for impairment of trade receivables account, which will therefore increase, and being a contra asset account by default, we will credit it. So we credit the allowance for impairment and trade receivables account by $15,200. And at 30 September 2015, we would be also recording an expense, which is the impairment loss on trade receivables, and all expenses whenever they are incurred by default are debited. And therefore, we'll be debiting the impairment loss on trade receivables by $15,200, right? So what we can understand is that previously, at the end of 30 September 2015, we would have already created an allowance for impairment of trade receivables account, which is a contra asset account. So since $15,200 is already stored there from the previous financial year, because we expect uncollectible amounts in the near future, and once that amount has been confirmed, which in Yum Yum's case is $5,200, we will reduce this allowance for impairment of trade receivables account by debiting it by $5,200, and that's what is being reflected for the decrease, okay? So we have two pairs of entries on the 1st of March 2016 that you need to perform for full marks. All right. So what about the end of the year at 30 September 2016? All right. So at 30 September 2016, we are given two new customers, Fabulous Foods and Fish and Fish. And altogether, they owe us $12,400. So this is the new balance that we must have at 30 September 2016 for allowance for impairment on trade receivables, this account which reflects the unlikely collectible amounts, okay? Now let's look into the balance that we had at 30 September 2015. At 30 September 2015, we had an allowance of $15,200, which we have created. Along the way, on 1 March 2016, this allowance reduced by $5,200 once Yum Yum confirmed about the bankruptcy and that they can't pay 80% of what they originally owed, which is $5,200, okay? And after that is done, then the balance remaining in the allowance account would be $10,000, right? And then at the end of the year, we have two new customers who may not pay us, and they are Fabulous Foods and Fish and Fish. The total amount that they may not pay us is $12,400. So from $10,000 to $12,400, there is an increase of $2,400, which is an increase in allowance for impairment of trade receivables. Whenever allowance for impairment of trade receivable increases, we have to credit it because, again, it is a contra asset account. And a contra asset account is an account which records all the reduction for a relevant asset account, and the relevant asset account in this case is the trade receivables account. So because the allowance is increasing, we'll credit it, okay, by $2,400. And simultaneously, always remember, whenever there's an increase in allowance for impairment of trade receivables, an expense is incurred for the business, which we record in the statement of financial performance, and that is impairment loss on trade receivables. And any expense, whenever it is incurred, is always debited. So we'll debit the impairment loss on trade receivables by $2,400, okay? All right, so for the year ended 30 September 2016, we have three sets of entries. So as you have seen, the first one, for the cash that we have received, the second one for the amount that we won't receive, and the last one being the final balance for the allowance for impairment of trade receivables that we need to adjust in the books. Okay, so now let's move to the new financial year, which is 1 October 2016 and ending 30 September 2017. Now, the first journal entry would be on 1 December 2016, which is the last paragraph given in the question. On 1 December 2016, Fabulous Foods was declared insolvent. The amount that it owed was confirmed as irrecoverable. Now, Fabulous Foods owed us how much? $4,600 at the end of 30 September 2016, which we have already stored in an allowance for impairment of trade receivables, as you have just seen here, okay? Now that these guys have declared that they're insolvent and 100% confirmed that we won't receive any of the amount that they owed, so what do we have to do? We have to reduce the allowance that we have already created before. So allowance for impairment is a contra asset account which when increases is credited. Now that they're decreasing, we have to debit it. So we debit the allowance for impairment of trade receivables by $4,600, which is the amount Fabulous Foods owed us. And simultaneously, we credit specifically the account of trade receivable Fabulous Foods by $4,600. This means the asset, which is Fabulous Foods, originally an asset to us because we thought we'll get the money from them, is no longer an asset. And now that assets are decreasing, we have to credit it. Okay? All right. Now we need to adjust for the ending balance. Now at 30 September 2017, we have all Shell who owed us $8,000, and we expect that these guys may not pay us. So what do? So now we adjust for this. At 30 September 2017, we understand the new allowance for impairment of trade receivables we would want at the books at the end of the period is $8,000. Now, after Fabulous Foods have confirmed that they won't be able to pay anymore, what was the balance left in the allowance for impairment of trade receivables? We started the period with a balance of $12,400, if you recall, from the end of 30 September 2016, which got carried forward as the opening balance on 1 October 2016 in the new financial year. In the new financial year, on 1 December 2016, what happened was that Fabulous Foods confirmed that they can't pay us, and therefore $12,400 was reduced by $4,600 for the amount that Fabulous Foods owed us, which gave us a balance of $7,800 left in the allowance for impairment of trade receivables, which now needs to be increased by $200 adjusted for the new allowance at the end of 30 September 2017. So every time there's an increase in allowance for impairment of trade receivables, our contra assets are going up, and when contra assets go up, we credit it, okay? And simultaneously, whenever there's an increase in allowance for impairment of trade receivables, the business has an expense, and all expenses incurred by default are always debited. So we would debit the impairment loss on trade receivables by $200. Okay, so that's all. So we have altogether 5 sets of journal entries for the year ended 30 September 2016 and 30 September 2017. And for you to correctly perform them, you also need to know what happened at 30 September 2015. So I believe that's what will help you guys get full marks. Now let's go to part B. Explain, using an accounting theory, why it is necessary to make an allowance for impairment of trade receivables. Now, we already understand that allowance for impairment of trade receivables is a contra asset account. And the reason we call this a contra asset account is because the asset account trade receivables, whatever likely reduction these trade receivables will go through, we will be storing them in a separate account, which is this allowance account, okay? Now, what does the prudence theory say? The prudence theory states that assets are not to be overstated and expenses are not to be understated. So if we look into these 2 points for the prudence theory and relate the overstatement of assets, we don't want to overstate assets. So what we're doing is that we report the net trade receivables in the statement of financial position or the balance sheet. And the net trade receivables is simply the difference between the gross amount, which is the original amount, and the allowance for impairment of trade receivables that we have at the end of the period when we're preparing the balance sheet. So you can see we are not overstating assets because the trade receivables are reported as net amount after the allowance is deducted. Now the expenses, which we also don't want to understate, is the impairment loss on trade receivables which we have incurred due to the fact that the allowance for impairment of trade receivables have gone up. Therefore, the business is obviously losing some profits there. So the expenses in this case is the impairment loss, which we also reflect in the books, mainly in the statement of financial performance. So you could use the prudence theory and you could explain the way I've talked about, and then you can easily get full marks. All right. Okay, so that's all for today's lesson. If you found value in this content, make sure to drop a like and subscribe to this channel, and check out the description for the links for POA 7087 and POA 7086 5-month intensive course programs which we are running starting in January. And with that being said, I'll see you in the next lesson.